So guys, still looking at top-down analysis and some of the things we need to know about top-down analysis. We've already looked at how we can navigate different time frames to get a trade setup. It's very important that we don't joke with this particular chapter because it determines whether we're going to get our trades correctly or wrongly. Very importantly. So I'm going to show you some other things you need to consider while doing top-down analysis, which is going to help your decisions, especially when you're taking a trade. So this is another trade example. Remember, we normally will go from the weekly time frame to the daily time frame, the 4-hour, and then our time frame of entry. So this is what I have right here on the weekly on this particular currency pair, and I want to show you how I would like to take trade in any of this particular direction, whether I'm going bullish or bearish. So this is the weekly. What do we do with the weekly? We normally look at the weekly to define where price is currently looking at or where price is currently going to. So what we have here is that price has been coming down all the way to this location, and the reason why we had to do things like market structure is to understand the current direction of price. And looking at this, we're going to have this as the current direction of price, a market structure shift. That is the only reason why we had to do market structure at the beginning of this mentorship, to properly understand how to spot directional biases. Now, there is something I call current bias or current directional bias, right? Current bias is very important because this is going to be the only reason why you get the right direction for your trade for a day. For day traders, this is very important. So if you don't understand your current bias, you may make some mistakes in taking trades that are not supposed to be taken, or you'll be taking trade in the wrong direction. So in doing top-down analysis, there is also something I need to show you. You have two things that you must work with. You see, in doing top-down analysis, you have, let's create a table. You have the left hand side of price and the right hand side of price. You see, these are the two things you must always look out for. So under the left hand side of price, this is where you're going to spot out things like your institutional reference points, things like your liquidity levels, things like your point of interest, right? Things like your area of focus. These are the things you're going to look out for on the left hand side of price. While on the right hand side of price, that is where price is currently printing your candlesticks, or that's where price is currently actively playing out. So this is where price is playing out currently, and in this we're going to target where price is going to. All right, where price is going to. In this same location, we're going to target what time frame we're going to enter our trade, the time frame of entry. So in this same example, I will show you how to use the left hand side of price and the right hand side of price principle. Looking at this, let's delete everything and leave just our charts. Now, look at what happened. Price had an impulse price swing massively to the bullish side. Let's assume this is what we are seeing. On the left hand side of price, we've seen how price crossed above this guy to create what? A market structure shift, and it actually cleared liquidity above here, liquidity above here. Now, what we've seen is that price massively traded into this area, even to this guy, which is resting around that area. That's a very important area, and we saw how price massively went there. And then what do you always look out for? Remember, we did those institutional reference points so we can see how some of those things are going to help us in analysis. This is a liquidity sweep. I called it liquidity sweep because price went above that liquidity sweep. So these are liquidity sweep for price. We have price going above that. So the next thing is that we have a liquidity void like this, assuming we just appear on our chart, and then this is what we saw on the weekly. This is exactly what we are seeing on the weekly. What do? You should expect liquidity void to be filled up. That is the first thing you should expect. This is an inefficient price action. We want to see price come back to fill it up, and this is for 2 weeks. So we are expecting price to trade down all the way, and if you're looking at this range, it's starting from this guy, this low to this high. That's the range entirely. Why? Because we still have this guy, this bullish order block, unmitigated, and we also have this fair value gap. This fair value gap has also been mitigated actually, so you don't have to worry yourself. So we are dealing with this entire price movement. The range is like this, and we have the 50% of this range from here. So we don't know when price is going to start filling up that liquidity void. That's why we need to go down to the lower time frame to look at what is happening. This is the 50% of that particular price level. So 50%, we'll write it like that. So from here, now we can drop down to the daily time frame and look out for a nice price action that will establish the retracement into this area. So we don't need to always wait for price to come down here before we take the buy. We can actually fill up this guy together with price, and basically what we are doing is that we are counter trading, but then the counter trading is our current buyers giving us an opportunity to take a sell into the discount area of the higher time frame direction. That is the only thing we need from the higher time frame. So taking out this guy and cleaning this, now on the daily time frame we're going to give our price action a different delineation. So we have price going up, and this massive candle, this is not a retracement, so this is price going back up. So we can call this a, that is, let's see, do we have a shift? That is basically a shift in market structure to the bullish side. Well, that is a break of structure rather, not a shift in market structure, because I've seen something else. Price came, retraced, massively pushing down, and this is another move. This is a shift in structure. We have 1, 2, 3 candles. We have a lower high here. So that is your market structure shift. Instead of this to be a market structure shift, then that is a break of structure. Remember, I told you that you're going to do this for every time frame differently. So let's see the daily time frame. And on the daily time frame, we started seeing price coming down massively. Now we may not be able to catch up a retracement or a shift in market structure to the downside here. That is why we need the 4-hour time frame, right? The 4-hour time frame will further give us a refined location. So you see, this guy is the fair value gap we have and a bullish order block that price may possibly trade into. So if that is the target for price on the 4-hour, we can now finally refine it and have the best opportunity for taking trade. So this is it. On the 4-hour, we're going to start monitoring it and expect to see price trade into our location. What do we have? We're going to take out this guy to this place, a shift in market structure here. This is a shift in market structure, and the next one is a break of structure. So this is why I said you should do these things for every time frame differently. Market structure shift, rightly placed. All right, you see, okay, this is the highest point and this is a break of structure. Doing that will help you to be able to know when price is going to start coming down. So right up here is our focus. We want to monitor a shift in market structure from the 4-hour time frame to establish the downward movement that is supposed to take us all the way down here. It can take us a week or even 2 weeks to have that closing. That is the liquidity void on the weekly. You see that? So in essence, what we are saying is that our current buyers should be bearish because that is the direction of the objective of price. That is to fill up the liquidity void we've had. Liquidity void are those massive candles we have, right? So we're going to see how price will give us a shifting structure. No shifting structure. We have a higher low here. Price went up, creating a higher high, creating another higher low here, failed to move above this guy. So this is our lower high. It created this. So let's see if we are going to shift structure on this area, and boom, here it is, here it is, here it is. You see, price went, had a failed swing, and it came down, creating this higher low, went up again, creating a higher high above this guy, and this area becomes our focus. If we created a shift in structure, or if we close below this guy, we will have a shift in market structure, right? That is a shift in market structure into the bearish direction. We attempted to do that here severally. We couldn't do that. And then the last one that we had, it actually closed below here with a fair value gap. Very important, very important. Notice what happened here. All this price action was efficient. All this area was not having any fair value gap, and price actually closed up all the fair value gaps. But then only this area has a fair value gap. That means we don't have price expecting, or we are not expecting price to go above here or even go there, because all the area have been cleared. You see, the reason why price normally retraces to a particular location is because of inefficiencies. Those are fair value gaps, right? So we don't have any in this location. Do we see any? No, there is no fair value gap, right? So the moment we saw price did this, creating that market structure shift, now we will have reasons to go bearish. Why are we going bearish? We're going bearish because we have the weekly time frame objective. So we will stop selling probably when we finally reach this area. The moment we cross this area, that's the 50% of that range, we'll be careful with selling. We'll expect price to trade into this area and then start buying. So this is it. Now you start looking at this area as your point of interest. You have a bearish order block, and what do you have? You have an imbalance. That's the fair value gap here. Are you seeing what I'm doing? And if you're seeing that, that is where you should be taking your trade from. And how do you do that? You are going to do either the aggressive, that's the risky trade entry, without looking at anything like confirmation. You just look for that area, spot it, your stop loss above this high, and you're going to target somewhere below here. All right, but then if you're looking for confirmation from the 4-hour, you will now drop down to the 15-minute time frame to get confirmation, and that confirmation direction is what you're going to use for the entry. So this is it. For confirmation, we have price trading into our point of interest. That's the area of interest. And we finally have a shifting market structure to the very side, which is this guy. Do you see this area? That's the shifting market structure. And what do? You will put your entry for that area here. That's a mitigation block, right? Yes, your stop loss somewhere above here. I think that's okay. And you're now going to target below 50%. And you see that we have a smaller risk exposure and then higher reward. So that is why the confirmation is always very important. So we're seeing price reacting and it's acting in that direction. So that is the trade for you, you see. So we're going to watch out for that and see. And I know these are the things that you're going to see. Price spiking, even almost going to stop you. And I'm going to teach you trade management actually. But then we're looking at this and see whether this is going to play out perfectly for us. Price is going in our direction. We have to be patient throughout this, right? It's because you're seeing it on the 15-minute time frame. But then let's see it on a little bit higher time frame. That's the 1 hour. So you see, do you see that? Do you see that? And that is the trade for you. Why? You have a confirmation and you did that. If you are not taking, even if you took this trade without confirmation, you will have still been in this trade. And that is like you're taking the trade somewhere from here and your stop loss is above there. But then you have a bigger stop loss, right? And you can even use the 3 candle price action. Do we have them? The swing high for that matter. Swing high. I think that's a swing high. See it here. On the retracement aspect, this is the swing high here. You have a swing high price coming back. You have 1, 2, 3 candles, and then this guy closing below the middle candle. The middle candle is basically the one that has the highest wick. This one, right? This one. So if you're taking your trade, you're going to take it from here, from short here, right? And your stop loss above the wick and the same target for that. Now you start being careful the moment price crosses below the 50%. The moment price crosses below the 50%, because you will most likely start seeing price aligning with the original direction. So we start being careful, even though it still has another journey to take. So we will watch from the 4-hour time frame and see if we are going to get there. You see price is coming down. Let's even go to the daily so we can have price go into the original bias now before we position ourselves. Now price has now dropped down into this area on the daily time frame. Remember, we can now start considering going bullish, but then we need the 4-hour time frame shifting market structure bullish again, and that is what we will use for the overall movement. And we're watching it. Is there a shifting market structure? No shifting market structure. We're watching it. Let's see how it will play out. Yes, I think that is a shifting market structure here. Let me show you. That is a shifting market structure. Did we go to our objective? Sorry, I haven't marked that area. Now this is it. Actually, we just traded into, let's see from the weekly. Starting from the weekly. All right, perfect. We traded into this area. This is it. This is the candle. And on the daily time frame, we have price. This area is very important. This fair value gap. Do you see that? This fair value gap is very important, and this bullish order block. Now notice what happened. Price traded into the fair value gap on the 4-hour time frame first, and then it shifted structure here. It shifted structure at this point. This is a market structure shift. So if I were to take a trade, that is a market structure shift. If I were to take a trade and align with the bullish direction, I would consider taking the trade somewhere around here. That is a bullish mitigation block, right? So I will wait for price to come down there. This is the 4-hour. So once price retraces to that area, I want to see confirmation. If you're using confirmation entry, we're going to see the difference here. For confirmation entry, I'm going to see a shifting market structure to the bullish side, and then I am going to take the trade from there. Do we have a confirmation? No confirmation. You see that? So if I am using confirmation, I wouldn't have taken that trade. But then if I'm using the risky trade entry, it will have been an entry for me, and then I will probably get stopped out, right? Because I'm going long from here. If I am considering this area, then I should put my stop loss somewhere below here and targeting above. I will keep on moving my positions, and I will keep on moving my stop loss to manage my trade. So I will get stopped out. So the difference between that confirmation entry and this particular risky entry I explained to you is like this. So even if you're doing the high frequency entry, that means you're not waiting for price, you will get stopped out. So if you're coming back to the 15-minute time frame, let's see if there was any confirmation like a swing high where that our entry was. There was no swing high formation, right? There was no swing high formation where that our entry was. So the entry confirmation helps you to filter out trades that are not going to allow you to take advantage of those kind of movements. So still on that same area, you can see that the daily time frame still has an order block. Now, it is important for you to know that that confirmation entry is what will help you to know whether price is going to use order block or a fair value gap for an entry. You see, we have both an order block and a fair value gap. Even though a fair value gap is supposed to be our priority, but then it can fail. This is trading, right? So confirmation is the only thing that will show us whether we're going to turn back from order block or we're going to turn back from a fair value gap. So on the 4-hour time frame, we're still watching it to see that we have that perfect entry. We're still watching it. If we see another shift, that is another shifting structure. You now see another shifting structure here, right? This is another second shifting market structure. We are still waiting for it. If we miss this or if we got stopped out here, we have a breaker now. This is a breaker block, right? This is a breaker block. So you're going to prioritize your entry from here. That's a market structure shift, and this is a liquidity sweep. Now we have finally touched our bullish order block. This as an orange or yellow shaded portion. So we're going to watch out for price to come down and give us confirmation. So we see it. We're waiting for it. We're waiting for it. We're waiting for it. Do we have price come down to the area we're waiting for? You see, now look at this. Look at what happened. High frequency, you see we have displacement, right? This one used high frequency, it never came to our area. So you're going to monitor these things from your end. This is high frequency because we never came here. It played out in the premium side of price. You see a proper example of that high frequency entry I showed you. So if I was to wait for price to come here, it wouldn't have taken me because I will wait for price to come and then go down to 15-minute time frame and have confirmation before entry. So I would have missed out of this. Even those people waiting for price to come, that's the risky entry, they are not supposed to be in this trade because this is where they are supposed to take the trade from the breaker. So you miss. The only guy that is going to get this is the guy that has high frequency, and the high frequency normally comes with a displacement. When you see price shift structure with such a massive displacement, the chances that it's going to come down is low. So you see how price actually played out on that area. So the only way you can do is to follow the trend. If you have another retracement, probably you're going to take advantage of that on this same area. So we're going to watch out for price. We have a break-off structure here. Now you begin to follow price because this is now originally the direction of the order flow. So you can follow price and see if we can get an entry. We have another area here for price to come down to. And if price comes down there, we can consider taking the trade again. If it never comes, that means we don't have a trade. We're seeing it. You see that price is moving. We are no longer coming here. Price had a retracement and a break-off structure. So break-off structure is for trade continuation, right? It's for trade continuation. But then here, there is a kind of price came, moved, had a retracement. This massive candle is considered to be a retracement for me. So in this area, there's something that looks like do you see this guy? It's a mitigation block, right? It's a mitigation block. All you have to do is to pick your path and design or sketch this and see. You see that it's a mitigation block formation, right? So that is another entry for you because you're now following the trend. You're targeting all the way up there to this liquidity. This is the original trend and you're not going to have trouble trading it, right? So price came back. Now, if you're taking this, you're going to look for confirmation here at this guy. Do you have a confirmation on the 15-minute time frame? Let's see it. On the 15-minute time frame, do you have any confirmation? Price came all the way down here. This is where it touched. You see, the shifting structure must only be considered or should only be considered when you finally touch the point of interest. Remember, this is the 4-hour mitigation block. So this can be a shifting structure, but then it's not important for us. Until we touch this, we're not using this guy. I hope this is understood, right? So this area, do we have an entry? Price came all the way, except if you're using the swing low, which is this. Probably we have this candle, this, and it's not a perfect one, obviously, all right? Except those who are taking the trade directly, those are the ones that will have that entry. So you see how price behaved on that area. Another break-off structure here. This is another break-off structure. If you took this trade, then fine, you will be offloading your position from that area. Or except if you looked at this from the 5-minute time frame, right? Let's go to the 5-minute time frame and see if there is an entry. I forgot that entry time frame, but then you can see it. We have still even on 5 minutes. It's not a good trade for me. It's not a good trade at this area. Price came and then quickly it shifted structure from here, and it also gave a high frequency entry. So except if you took the trade without confirmation, and that is why I said with confirmation entry you're going to have lesser trades, but then they are high quality trades, right? They are high quality trades. Such kind of trades don't get you stopped knocked out easily. Break of structure. Now price came back here, another location for entry. Bullish order block was tapped and price keeps on moving in that direction. You see, okay, now we saw this. Notice what happened. See what price did. Price went up after these guys have taken their profit. It came back again. Created manipulation, inducement in this area. Probably this should be a news, right? News actually created this. It happens like that, and then before price can finally align, price used this bullish order block, a small candle here, and moved out. So this was a massive one for price coming down. This was a news. So if you are looking at your economic calendar, you shouldn't be part of that. Now, after coming here, price is now trying to align back up. So you should be avoiding that particular location. So price had this can also be a shifting structure, and this is a retracement. I mean, this is a push up at this point. This is another shifting structure to the bullish side, and price used this area for movement, right? Boom, inside that area to go up again from the 4-hour time frame. Now we're finally taking out the bigger time frame. I mean, that's the swing break of structure from that area, and price keeps on moving. Notice what price is doing. The target or the objective is this liquidity up here, so you can follow this trade all the way to that area as price is moving up. You see that price is creating all the opportunities for you. Now at this point you should be careful. There is a shift in market structure bearish. You should be careful, avoid it, because you are even at the premium side of price, that is this area. So be careful with that, and then avoid trading activities there until when you finally cross above this guy, and then you can now realign with that. So you should be careful. That is why you have a watch list of other assets to look out for. But then price actually played out in that direction. Now coming back, and boom, price is going still on that direction, finally targeted this area. You see how price massively came down after it traded into the liquidity. You see that massively came down. So that is very important for interpreting price movement. As you trade in that direction, you're going to experience this happening from the top down perspective. Everything you're going to do is going to be either in the direction of the original trend or against the trend that you're dealing with. So everything here is in that direction. We've had price going in that direction. This is against the direction, but then still we had some trades we took into the discount area, and then this one we missed this guy, except if you're using that entry criteria, and price went up to this area, and probably you are seeing this area as a break of structure also for trade entry. You're looking at this area, your entry should be somewhere below here, which price never reached, and that is not an entry for you. That's not even a trade. You shouldn't take this because we just cleared the liquidity above here. The chances that we're going to reverse into this area is high. So that is why you should work with multiple time frames if you're taking trade to interpret your price action in that manner. I hope this video helps you to understand this properly. As we go into the community, you're going to see me do this every day. It's not something you should worry yourself. You're going to learn it better as I do it and interpret it for you in a live market scenario. So guys, this is all about this video. I hope this video helps you. See you in the next chapter.